Hey, let's jump right into this explainer and start building out your mental notion board. If you're a BS accountancy student, you know you need to hack the Philippine tax code. Our goal today? It's not just to cram for your next quiz. We're locking in this knowledge for 3 whole years, so you can absolutely crush the LXCPA. We're going to decode the concept of taxable income and gross inclusions and really get into the mechanics of how the BIR and your board examiners actually think.
So, here is your 6-step study map for dominating those LECPA tax income questions. We've got 1. The concept and requisites of income. 2. Section 32A, gross inclusions. 3. Forms of special compensation. 4. Hacking rent and leasehold rules. 5. Influencers, partners, and illegal gains. And 6. A quick LECPA bullet review. Let's get to it.
Section 1. Concept and requisites of income. Defining the core framework.
Okay, we've got to set up your core framework first. Because honestly, if you understand the why, the what becomes so intuitive. You literally cannot hack a multiple choice question if you don't know what the tax code actually considers to be income. Think of capital as a tree and income as the fruit. This is a super vital distinction because a mere return of capital is never taxable. Zero. For example, the tax code sees your life, your health, and your reputation as capital with infinite value. So if you get moral damages for a ruined reputation or a payout for a physical injury, you are just recovering your capital. There's no fruit there, so it's completely tax exempt.
Right, so for any item to actually trigger a tax liability, it has to pass through 3 sequential steps perfectly. First, there needs to be a true flow of wealth, a gain. Second, it has to be realized, like mere appreciation in a property's value that isn't taxed until you actually sell it and realize the gain. And third, it must not be explicitly excluded by the Constitution, the tax code, or any treaties. If an item fails even one of these steps, boom, it bounces right out of your taxable income computation. Moving on to Section 2. Section 32A, gross inclusions, the rules of the game. So, how does our framework build into the specific inclusions the Bureau of Internal Revenue is actually targeting? This is where the theory hits the real world. Okay, active recall time. Search your brain for a second. If you were drafting a tax return right now, what are the primary streams of wealth you are legally required to record? Did you get them? This chunked list is your core gross inclusions. You absolutely need to memorize these categories because they are the foundation for literally every complex multiple choice question you're going to face. And hey, notice the phrase compensation in whatever form paid. That means the BIR does not care if you get paid in cash, crypto, or cars. It is all gross income.
All right, Section 3. Forms of special compensation. Moving beyond standard salaries.
The crucial takeaway here is that compensation isn't always just a neat stack of cash in an envelope. The form it takes can completely flip its tax treatment. And this is exactly where examiners love setting traps for second and third year students. You'll definitely want to take a mental screenshot of these rules. They love testing directors' fees. If the director is an employee, the fee is compensation income. If they aren't an employee, it's a gross professional fee, subject to creditable withholding tax. Also, look at forgiven debt. This is huge. If your boss forgives your loan because you worked late all month, that's compensation. But if your friend forgives your loan just out of the goodness of their heart with no services rendered, that's a gift. And that means it's subject to donor's tax, not income tax.
And this perfectly illustrates the promissory note trap. If a client pays you for your accounting services using a promissory note, you always have to verify if that note has interest. If it's interest-bearing, you report the full face value in the year you receive it. But if it's non-interest-bearing, you only report the fair discounted value in year 1. Then, you report the recovered discount as income in the year it finally matures. Do not let them trick you on this one.
Section 4. Hacking rent and leasehold rules, landlords, tenants, and taxes.
We're entering an area where unprepared students leak massive points. The complex mechanics of rent and leasehold improvements require pure logic, so let's map it out. Here's your active recall prompt. Imagine you're the lessor. Your tenant hands you 2 years of rent completely upfront. Do you spread that out over 2 years for tax purposes, or take the hit now? The answer? Advanced rentals under an unrestricted claim of right are fully taxable in the year received, period. And that's regardless of whether the lessor uses the cash or accrual accounting method. But wait, what happens when a lessee builds an improvement, like a whole building, that will eventually belong to the lessor when the lease ends? Well, the lessor gets 2 binary choices for reporting that income, the outright method or the spread out method.
Now, the outright method is super easy. You just tax the fair market value upon completion. Done. But if an exam question asks for the spread out method, you need to trace this exact chronological path. First, take the cost of the building. Then, subtract the depreciation that will happen during the lease term. That gives you the book value at the exact moment the lessor takes ownership. Finally, divide that value by the remaining years of the lease. That gets you your annual recognized income. Practice this formula until it literally becomes muscle memory.
Section 5. Influencers, partners, and illegal gains. The exam edge cases. Let's tackle the climax of our study guide, the highly specific, modern, and honestly, kinda weird scenarios that act as true board exam separators. Knowing these edge cases is exactly what pushes a score from a 75 to an 85. For instance, if you steal money, do you owe the government a cut? Well, the James Doctrine dictates that yes, unlawful gains are strictly taxable. The logic here is that an embezzler has absolutely no intention of repaying that money, so it represents a real flow of wealth. The BIR stance is essentially, look, we don't care how you got it. If you got richer, you owe us. Let's look at a few more modern setups. Social media influencers are a huge target for the BIR right now. You need to treat an influencer's free product endorsement just like compensation in kind, meaning it is taxed at its fair market value. Also, keep in mind that your distributive share from a general professional partnership, or GPP, is absolutely included in your gross income. And for long-term construction contracts, the BIR mandates the percentage of completion method, which means you recognize the income as the work is actually being done.
Section 6. LECPA Bullet Review. Cementing the neural pathways.
Okay, we've broken down the system. Now let's hit the ultimate save point with a high-yield bullet review. These are the exact tricks that show up on the LECPA year after year, so let's lock in that 3-year retention right now. Number 1, never let them tax a return of capital. Number 2, watch out for the security deposit trap. A security deposit is purely a liability. It is never considered income unless the lease contract is broken and the deposit is forfeited to cover unpaid rent. And lastly, if a lessee pays the real property tax on behalf of the lessor, that is considered constructive rent and is fully taxable income to the lessor.
A few more traps for you. If a corporation condones the debt of a stockholder, your brain should immediately flag that as an indirect dividend distribution. It is not a gift. Next, if you get paid in company stock, you report the fair market value at the exact time the services were rendered, not when the stock was actually issued. And if a lease is pre-terminated, the lessor must immediately recognize additional income if the value of the leasehold improvement exceeds what they've already reported.
We have covered a ton of ground today, from the tree and fruit analogy of capital and income, to the mechanics of leasehold improvements, to even the taxation of illegal gains. Continue using this visual schema to categorize every single tax problem you encounter. Because when you understand the underlying framework of the tax code, you don't just blindly memorize rules, you actually learn how to think like an examiner. Keep this mental structure sharp, and you will absolutely dominate the board exams. But hey, knowing what is included in income is only half the battle. Once you know your gross income, how much of it can you legally shield from the BIR using allowable deductions? We'll hack that in our next explainer. See you then.